December 11th, 2025. Silver touches $63.58 per ounce. Headlines scream, new all-time high. Financial media celebrates. Investors pile in with FOMO, afraid they've missed the move. But here's what they're not telling you. This record wasn't set yesterday. It was locked in weeks ago when something broke in London that most people still don't understand. While everyone watches the price ticker flash green, the real story is happening in the vaults. And what's happening there suggests this rally to $63 isn't the top, it's the floor. The trap has already been set, and the target isn't $70 or $80. The mathematics of what happened in October and November point to something far bigger, something that could reshape our understanding of precious metals entirely. Let's start with what actually happened on December 11th. Yes, silver hit $63.58. Yes, that's a new nominal record, but the why reveals everything about where we're headed next. The day before, December 10th, the Federal Reserve cut interest rates by 25 basis points at their FOMC meeting. Standard stuff, expected move. Market analysts had priced it in. But silver didn't just rise modestly on dovish Fed policy the next day. It exploded $2.45 in a single trading session. That's a 4% move in one day for a metal that's supposed to be less volatile than crypto. Think about that for a moment. When was the last time you saw gold move 4% in a single day without a major global crisis? Why did silver rocket like this? Because the Fed rate cut was just the match. The powder keg was already packed and waiting, loaded with months of accumulated pressure that most traders completely missed. Here's the mechanism most analysts got wrong. When the Fed cuts rates, the dollar typically weakens. When the dollar weakens, commodity prices usually rise. Basic economics. But silver didn't rise like a commodity responding to monetary policy. It rose like an asset in physical shortage, getting bid up by desperate buyers who need actual metal, not paper contracts or ETF shares. The tell? Look at what happened before December 11th. The entire month of December, silver was consolidating in the $57 to $60 range, not crashing back to $50, not correcting after a big run, just sitting there, holding gains, waiting. That's not normal price discovery where sellers and buyers find equilibrium. That's constrained supply meeting persistent demand. That's a market where the physical metal is already spoken for, and every Fed rate cut just tightens the noose around the shorts who promise delivery they can't make. Now, let me tell you about October 2025, the month when the trap was actually set. The month that explains why $63 is just the beginning. Something extraordinary happened in London that month. Something that should have made front-page news but barely registered outside specialized metals trading circles. Silver lease rates, the cost to borrow physical metal from vault holders, exploded to 200% on an annualized basis for overnight borrowing. Read that again. 200% annual interest to borrow silver for just 24 hours. To put that in perspective for you, normal lease rates for silver run 1 to 3% annually. In times of market stress, they might spike to 10 to 15%. During the 2008 financial crisis, they briefly touched 20%. But 200%, that's not stress. That's not even a crisis. That's full-blown panic in a market that's supposed to be liquid and functional. Who pays 200% overnight rates? Traders who are forced to deliver physical metal they don't actually have. Short sellers who sold paper silver contracts but now face physical delivery. Demands from buyers who want the real thing. Financial institutions that promised metal to their clients but suddenly can't source it from the market at any reasonable price. Rona O'Connell, head of market analysis at StoneX, said it plainly in an October interview. There was basically no available metal left in London. Think about what that means. London is the global hub for precious metals trading, the physical marketplace where institutions around the world source their silver. And in October 2025, it ran dry. One trader who was there described the scene to Reuters. A lot of people were very stressed, to put it mildly. That's trader speak for absolute chaos. This wasn't a temporary blip that resolved in a day or two. The numbers tell the deeper story. London Bullion Market Association vaults held 31,023 metric tons of silver back in June 2022. By March 2025, that number had fallen to 22,126 metric tons, a one-third decline in less than 3 years. And by October 2025, when lease rates hit 200%, the available metal for immediate delivery was effectively zero. Every ounce that wasn't already allocated or spoken for had been drained from the system. That's when the trap snapped, shut on everyone who thought they could short silver with impunity. But here's where it gets even more interesting, where our government's actions tell us everything about what they see coming. 1 month after the London crisis, in November 2025, the United States government officially designated silver as a critical mineral essential to national security. This wasn't symbolic politics or bureaucratic paperwork. The U.S. Geological Survey doesn't hand out that designation lightly. It's reserved for materials that meet 3 specific criteria. They must be essential to our national defense and economic security. They must be vulnerable to supply chain disruptions. And they must be concentrated in foreign sources we don't fully control. Silver just joined rare earth elements, lithium, and cobalt on that list. Let that sink in for a moment. Our government looked at what happened in London in October, a complete physical shortage in the world's largest trading hub, and said, "We have a strategic problem here. If there's no physical silver available when we need it, and industrial demand keeps rising from solar panels, electric vehicles, and AI infrastructure, we're looking at a national security vulnerability." The record price at $63, that's just the market starting to price in what happened in October and what Washington confirmed in November. The real move, the move that takes us to triple digits, hasn't even started yet. Because once the market fully understands that the physical metal is gone and industrial users are about to start fighting over what's left, $63 will look like the bargain of the decade. Let's start with the math that can't be argued with, the numbers that Wall Street doesn't want you focusing on too carefully, supply and demand. The Silver Institute released their 2025 World Silver Survey in November. Right around the same time, our government declared silver a critical mineral. Interesting timing, don't you think? The numbers they published are stark, and they explain everything about why we saw that panic in London and why $63 is just the starting point. 2025 global silver supply from mining, 813 million ounces. 2025 global silver demand across all sectors, 1.12 billion ounces. The deficit, 307 million ounces. That's not a typo. We're consuming 307 million more ounces than we're pulling out of the ground this year. But here's what makes this truly alarming. This isn't a 2025 problem that just popped up. This is a structural crisis that's been building for years, while everyone was distracted by crypto and tech stocks. This marks the 5th consecutive year the silver market has been in deficit, 5 straight years of consuming more silver than we mine, 5 years of drawing down above-ground inventories that took decades to accumulate, 5 years of pretending paper contracts can somehow substitute for physical metal when industrial users need the real thing. So, where does the deficit get filled each year? Recycling and existing stocks sitting in vaults and warehouses. But here's the problem that's now catching up with us. Recycling can't keep pace with industrial demand growth. And those existing stocks are exactly what disappeared from London vaults between 2022 and 2025. The buffer is gone. Philip Newman, managing director at Metals Focus, presented these findings at the Silver Institute's annual industry dinner in New York. When someone asked him about the supply outlook going forward, his answer was blunt. Mine production has been essentially flat for years, while structural industrial demand is rising. That's a diplomatic way of saying we're running out, and new supply isn't coming to save us anytime soon. Think about what that means for you as an investor, or as someone trying to understand where prices are headed. We have 5 years of deficits behind us, flat mine production ahead of us, and accelerating industrial demand in front of us. That's not a recipe for stable prices. That's a recipe for a supply crisis that gets solved only through much higher prices rationing demand. Now let's talk about where the physical metal is going and why it's not coming back into circulation anytime soon. As of December 2025, the largest silver-backed ETF, the iShares Silver Trust, ticker symbol SLV, holds 15,415 tons of physical silver in vaults around the world. That's 495 million ounces locked away. To put that in context, you can grasp. Global silver mine production in 2025 is 813 million ounces. This one ETF alone holds 61% of one year's entire global mining output. One fund. Think about that. Add in the other major silver ETFs, Global X Silver Miners, ABRDN Physical Silver Shares, and dozens of smaller funds, and you're looking at over 700 million ounces locked in ETF vaults worldwide. That's nearly an entire year of global mine production just sitting in storage, completely unavailable to industrial users who desperately need silver for solar panels, electronics, and electric vehicles. And here's the kicker that creates the trap within the trap. When silver prices rise, ETF inflows actually accelerate. It becomes a self-reinforcing cycle. Investors see silver going up, they pile into ETFs to catch the move. Those ETFs buy physical metal and vault it. And that metal doesn't circulate back into the industrial supply chain where manufacturers need it. It just sits there, accumulating, month after month. Morgan Stanley noted this dynamic in their Q4 2025 commodities report, and their language was surprisingly direct for a major bank. Silver ETF inflows have created a self-reinforcing supply squeeze. Higher prices drive more ETF buying, which removes more physical metal from circulation, which drives prices higher. They're describing a feedback loop with no natural stopping point except much higher prices or industrial users finding substitutes. And there aren't good substitutes for silver in most applications. While investors are locking up supply through ETFs without even realizing the impact they're having, industrial users are screaming for metal they can't get at any reasonable price. Solar photovoltaics alone consumed 232 million ounces of silver in 2024. That's nearly 30% of total global mine production going into just one sector. And that number isn't plateauing or declining, it's accelerating. China installed record solar capacity in 2025, and global solar installations are projected to double by 2030 under current green energy mandates from governments around the world who've committed to net zero targets. Here's why solar manufacturers can't just switch to something else. Each solar panel requires silver for electrical conductivity in the photovoltaic cells. There's no perfect substitute that performs as well. Copper and aluminum can't match silver's performance in this application. As Metals Focus noted in their research, silver's superior electrical and thermal conductivity is indispensable in the technological transformation sweeping the planet. Add electric vehicles into the equation. Silver in EV motors, battery management systems, and charging infrastructure. Add AI data centers that are being built out at breakneck speed. Silver in servers, cooling systems, and high-performance computing hardware. Add 5G telecommunications infrastructure, silver in antenna systems and circuit boards. You have structural demand growth hitting a market that's already been in deficit for 5 straight years. The Silver Institute expects industrial demand to remain above 665 million ounces annually through 2030. That's 81% of current mine production before you even count investment demand, jewelry demand, or coinage. Let me repeat that. Industrial users alone will consume 81% of everything coming out of the ground, and that percentage is rising every year as solar and EV adoption accelerates. The supply-demand math isn't just tight anymore, it's broken. And that's what the October lease rate spike was telling us. The market was screaming that the physical metal isn't there to meet demand at current prices. Here's where the $63 record gets really interesting when you put it in historical context, because the headlines about all-time highs are technically true but deeply misleading. The previous nominal high was $49.95 set back in January 1980 during the Hunt brothers' infamous attempt to corner the silver market. That was manipulation. 2 Texas billionaire brothers buying up massive amounts of physical silver and futures contracts to artificially drive the price higher. It worked until it didn't, and the market eventually crashed when regulators stepped in. But here's what the financial media isn't telling you when they celebrate the new record. Adjusted for inflation using standard CPI calculations, that 1980 peak of $49.95 equals roughly $200 per ounce in 2025 dollars. So when headlines scream, silver hits all-time high, what they actually mean is Silver finally broke its nominal 1980 peak, but it's still 70% below its inflation-adjusted high from 45 years ago. Let that sink in. We're celebrating a price that, in real purchasing power terms, is less than one-third of where silver traded in 1980. And here's the crucial difference between then and now. The 1980 spike was artificial manipulation by two individuals trying to corner the market. Today's move is driven by fundamental realities that can't be manipulated away. What's driving silver today? Structural supply deficits, 5 consecutive years. Physical shortage, London vaults running empty. Strategic government designation, critical mineral status for national security. Accelerating industrial demand from solar, EVs, and AI infrastructure that isn't slowing down regardless of what happens in the broader economy. The difference between 1980 and 2025? Back then it was a bubble created by manipulation. Today it's a fundamentals-driven supply crisis that's only going to intensify. And if silver is still 70% below its inflation-adjusted 1980 high, while facing much stronger fundamental support than existed back then, where does that suggest prices are headed next? The mathematics point to triple digits, and soon. Let's do the math everyone's avoiding, the calculation that explains why 100 plus silver isn't speculation or hype. It's mathematical inevitability. The silver market has been in deficit for 5 consecutive years. We've covered that. But let's actually add up what that means in cumulative terms, because the total number is what matters for understanding where we are right now. Using conservative numbers from industry sources, 2021 deficit was roughly 250 million ounces. 2022 deficit was 237 million ounces. 2023 came in at 184 million ounces. 2024 posted 215 million ounces, and 2025 is tracking at 307 million ounces. Add those up. Total cumulative deficit from 2021 through 2025, 1.193 billion ounces. That's 1.2 billion ounces consumed from above-ground inventories over just 5 years. To put that in perspective, you can grasp that's 1.5 years of total global mine production just gone, drawn down from stockpiles that took decades to build. Where did it come from? London vaults that are down 33% since 2022. COMEX warehouses that saw repeated drawdowns throughout 2024 and 2025. Private holdings liquidated as prices rose and investors took profits. But here's the trap that's now closing. Those above-ground stocks are exhausted. When London lease rates hit 200% in October 2025, that was the market screaming there's no more buffer left to draw from. So what happens in 2026 when solar installations continue accelerating? China just posted record installations, and our Inflation Reduction Act subsidies are driving domestic solar adoption. When EV production keeps ramping toward the global target of 30% of new car sales being electric. When mine production stays flat because no major new silver mines are coming online until 2027 or 2028 at the earliest. The deficit doesn't shrink, it widens. And when there's no above-ground inventory left to draw from, price becomes the only mechanism left to ration supply. That means industrial users bidding against each other, investors competing for whatever metal they can find, and prices rising until demand finally gets crushed, or supply miraculously appears. Guess which one happens first? Now, let's talk about the gold-silver ratio, because this is the most reliable indicator of where silver is heading next. And right now, it's flashing the same signal it flashed before silver's biggest moves in history. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is undervalued relative to gold. When the ratio is low, silver is fairly valued or overvalued. It's that simple. Back in April 2025, the ratio hit 107. That meant it took 107 ounces of silver to buy 1 ounce of gold. Silver was extremely undervalued. By October 2025, the ratio had fallen to 78 as silver started catching up. By December 2025, we're around 65 to 68. And silver's momentum is building. Here's why that matters. Historical precedent shows us exactly what happens when this ratio breaks below 70 and keeps falling. In 1980, during the Hunt brothers saga, The ratio collapsed from 40 down to 17 as silver exploded from $10 to $50. In 2011, during silver's last major bull run, the ratio fell from 65 down to 31 as silver surged from $30 to $48. We're at 65 to 68 right now, sitting right at the same level where silver took off in 2011. If history rhymes, and it usually does in commodity markets, and the ratio falls toward 40, which is a reasonable target given the supply fundamentals we've discussed, that implies something significant. Take gold at its current level, around $4,200 per ounce. Divide that by 40. You get silver at $105. But what if the supply crisis we're facing pushes the ratio even lower than 40? What if industrial demand creates the kind of panic we saw in London in October, but on a global scale? At a ratio of 30, which we actually saw as recently as 2011, you get gold at $4,200 divided by 30, which equals silver at $140. The ratio isn't just falling because silver is catching up to gold in some abstract way. It's falling because silver has something gold doesn't have, massive and growing industrial demand that can't be substituted away. When physical shortage meets industrial necessity, when solar. Manufacturers and EV producers need silver and can't get it. The ratio can compress violently in ways that shock even experienced traders. Here's why $100 plus isn't speculation or wishful thinking from silver bugs. It's mathematical inevitability based on multiple convergent scenarios, and even the conservative ones point to triple digits. Scenario 1, inflation-adjusted 1980 peak. We've established that the 1980 high of $49.95 equals roughly $200 in today's dollars. If silver simply returns to its inflation-adjusted 1980 peak, that's $200 per ounce. But here's the kicker. That 1980 peak was driven by manipulation, artificial demand from two billionaires cornering the market. Today's fundamentals are actually stronger. Structural deficits, physical shortage, strategic government designation, accelerating industrial demand. If manipulation drove it to $200 in inflation-adjusted terms, what does a real supply crisis drive it to? Scenario 2, gold parity performance. Gold's 1980 peak was $875 per ounce. Today, gold trades around $4,200. That's a 380% increase above the 1980 nominal peak. Apply the same multiple to silver. Take $49.95 and multiply by 3.8. You get $189 per ounce. Silver simply matching gold's performance from 1980 to now puts us at $189. Scenario 3, industrial supply crisis, which is what we're actually facing. Solar demand alone will consume 300 plus million ounces annually by 2027, up from 232 million in 2024. That's 37% of total mine production going to just one sector. Add electric vehicles, AI data centers, and 5G telecommunications, and you're looking at 500 plus million ounces of industrial demand. If mine production stays at 813 million ounces, and remember, it's been flat for years, and industrial demand takes 500 million, that leaves only 313 million ounces for investment demand, jewelry, and coinage. Current demand from those sectors runs over 450 million ounces. That's a structural shortage of 137 plus million ounces annually, even after we've already burned through 5 years of deficits. Price has to rise until one of two things happens. Either industrial users find viable substitutes, and we've established there aren't good ones for silver's electrical conductivity, or they ration their consumption, which means slower solar adoption, fewer EVs, delayed AI infrastructure. Neither outcome is politically acceptable to governments that have committed to green energy transitions and technological advancement. Morgan Stanley's commodities desk, which tends to be conservative in their projections, is now forecasting $100 to $120 per ounce by Q3 2026, based purely on supply-demand modeling. They're not silver bugs. They're a major investment bank looking at the same numbers we're looking at and reaching the same conclusion. The math doesn't work at current prices. Here are the specific catalysts to watch as this unfolds, the timeline that takes us from $63 today to $100 plus over the next 9 months. Q1 2026, January through March. Watch for Chinese solar installations to surge after the Lunar New Year as manufacturing ramps back up. Watch for ETF inflows to continue if the Federal Reserve maintains its dovish stance and cuts rates again in January or March. The target range for this period, $70 to $80 per ounce as the gold-silver ratio compression continues and more investors realize what happened in London. Q2 2026, April through June. This is when U.S. solar projects accelerate ahead of the summer installation season, when weather is optimal for large-scale construction. This is also when London vault inventories get tested again, as industrial users stock up for peak manufacturing season. Target range, $85 to $100 per ounce as physical tightness returns, and the market starts pricing in summer demand. Q3 2026, July through September. Peak solar manufacturing season hits as factories produce panels for winter installation deadlines. If supply conditions haven't improved, and there's no reason to think they will with mine production flat, we could see a second lease rate spike similar to October 2025. Industrial users start panic buying to secure supply. Target range, $100 to $120 per ounce as the full reality of the supply crisis becomes undeniable. The record at $63 isn't the story. The story is what the October lease rate spike and November critical mineral designation revealed about the true state of the silver market. The physical metal is gone. Industrial demand is accelerating regardless of price. And price is now the only rationing mechanism left to balance a market that's been out of balance for 5 straight years. The trap was set in October when London ran dry and lease rates hit 200%. The $63 record is just the market beginning to realize the trap exists and starting to price in the implications. $100 plus is what happens when it fully closes, when every industrial user, every investor, every government that needs silver for strategic purposes simultaneously realizes there isn't enough to go around at current prices. This isn't about fear or panic. This is about understanding the mathematics of a supply crisis that's been years in the making and positioning yourself accordingly before the full weight of that reality hits the broader market. The institutions already know. That's why lease rates hit 200%. That's why our government designated it a critical mineral. Now you know too.